Josh, Capital One. This was stock down, but the reasons why, at least to me, were a little surprising. What do you think?
Yeah, so Capital One, pretty big miss last night. Three reasons. One is what we'll call late cycle. Two is what we'll call hidden exposures.
Late cycle, like credits, late cycle. Credit.
Yeah, okay. and I'll go through that. Okay. And third is really this sort of ongoing digital transition. So the late cycle dynamic is interesting. There's sort of an obvious component and a less obvious component. The obvious component is that when you've been in an economic expansion for 7 years and you go back and you look at prior cycles, they tend not to last too much longer than what we've already seen.
Yeah, I know a macro team that talks about that sometimes.
Yeah, it's been known to come up in conversations around here. So that's sort of the obvious element. What's less understood or less appreciated is that financials are extremely sensitive to this late cycle dynamic. And the reason for that is because financials, when the cycle is sort of at its maximum pain point, and then sort of things are getting better, initially less bad, then better,
yep.
And then they're expanding, financials pick up a huge tailwind from what's called reserve release. So this actually overstates their earnings power for a number of years. But then what ends up happening is that once you're late cycle, you're no longer releasing those reserves. You're now actually starting to build reserves.
You have to reserve.
Yeah. And so what ends up happening is that the earnings power of a financial actually gets sort of smoothed out over a long period of time. And so what people sort of assume is that, well, they've got loan growth and therefore they should have earnings growth. But in reality, that loan growth simply precipitates flat earnings and even earnings that can come down.
Okay.
And so that's sort of the first element of what we saw in the Cap One numbers is they had their provision expenses, which is for bad loans, up about $250 million above what people were expecting. So that caused most of the loss. Beyond that, they acquired a bank in 2005 called Hibernia, which is back then was the largest Louisiana-based regional bank. There's one other, it's called Iberia. The point is, most of the Hibernia loan book is energy. And as you know, obviously, energy has been basically cut in half for a year now. And that finally came home to roost in the Cap One numbers in the second quarter. And so they took up pretty big reserves against that. And then the other thing they've got going is, it's small, but they've got this sizable taxi medallion portfolio. So there's this company Uber, which is causing them to take some reserves against that. And then the third thing going on is that Cap One is, they're a pretty progressive bank as banks go, and they're sort of on the vanguard of trying to undergo this sort of traditional branch model bank system into a digital banking system. And so they're spending a lot of money to make this happen. And every now and then they spend more money than what people were thinking. So the confluence of those three things, of being late cycle, energy exposure, taxi medallions, and dumping a lot of money at the wrong time into this digital transition, caused them to have a pretty big shortfall on earnings.
This is why I wanted to make the call out, because I think a lot of people that are watching this, and particularly a lot of people have been trained to be stock pickers. They don't really have a macro process. If they could have a macro process, we would suggest that you'd at least lend part of ours. What you really said, those three things to me are macro things. I mean, if you're just navel gazing as a credit card analyst on Capital One metrics and pro-cyclically so again, to your point, saying, oh, earnings are good, I'm going to buy the stock. That's about the dumbest thing you could have possibly done on this number, because you have late cycle, you have the energy market you should have been concerned with, and you have Uber, which is obviously a technological innovation. This is a huge difference than just being a run-of-the-mill credit card analyst.
Yeah, well, this is why we pulled this stock off our best ideas list 2 weeks ago.
It was a great call.
Well ahead of earnings, because we didn't want to be there for this print.
If you didn't do that, we wouldn't have had him here today, by the way.
Always good to be welcome.